Rohit Srivastava, fund manager with Sharekhan, is joining us right now. Rohit, good morning. Good to have you with us here. So we are, we bounced a little bit yesterday. Is this got a little bit more legs, Rohit, you think? Or it's already out?
No, my sense is there could be more legs. The only thing is we are running into, both the end of the year and an event that I think too many people are watching closely, even though it may appear discounted. So probably those legs will appear more clearly only after in the second half of this month. So right now, all I'm able to say is that we have extremely oversold readings, and while every day you can see stocks falling and the index, not really holding on, which can be a little painful. Unlike we are almost 9 months into this sell-off. The Bank Nifty peaked almost a year back in late January. The Nifty itself peaked in March at 9100, and we are 9 months into it. So this creates room for you getting some kind of a better bounce back rally in the market once the selling is exhausted. So that's what I'm watching out for. We are still not getting complete signals, though this is, I think, a very good level where we bottomed yesterday close to 7600. In fact, even on Bank Nifty, we held the 16,600 mark almost 3 times now in the last 2 months. And as long as these levels hold, my sense would be that at some point we would start developing a rally in the market. So that's what I'm trying to get my hands on.
Let's assume that the market does nothing for the next couple of days, right? I mean, only a few days left for the Fed decision. And after the decision, there is a bit of the bounce resumes. Which sectors do you think are prime candidates to participate in that bounce?
Well, I think banking might be one primary sector, even though it's been the most beaten down, for the simple reason that it is outperforming the Nifty right now. Like I said, it's not broken 16,600. The equivalent Nifty level would have been somewhere around 7,900. There's a big gap between the two. And since it's holding out, it would probably end up being a better sector on the way up as and when that move develops. So that would be one that I can think of. Apart from that, it might be particular stocks. I mean, you've seen a lot of beating down in, say, maybe pharma and FMCG stocks. They could participate again. So the defenses might still remain the theme. But definitely, I think what we are seeing has been a very, very strong mid-cap and small-cap rally, although it can get speculative at some times. That might continue to be strong as well, because those indices also have actually held on even more than the Bank Nifty itself. So the mid-cap and small-cap indices have only retraced 50% of the gains that they made in October, November. They've not gone below that. So they're actually doing better than the index itself.
Yeah, fair enough. Metals, no such luck, right? I mean, actually, just stay with the stronger sectors after the 15th as well. I mean, if there is a bounce, relatively stronger sectors.
No, you mentioned metals. That's really important, because my call for some time, I think even previously we discussed it, that we could get a meaningful bottom in the metals, and there are some very good intermarket divergences. For example, you saw the copper prices fall to a new low in around a week or two back, and it's not really falling anymore. However, when that happened, stocks like Tisco, Hindalco did not really fall below their October lows, so they've actually held on to those bottoms that they made, even as metal prices fell lower. So that leads to some kind of a positive divergence. We haven't seen a strong rally again in metals after that small rally that we got first in October. They've mostly corrected but not fallen to a new low. So that means you've got a higher bottom in place. So if there was a contrarian bet to take, it will be metals. I think that's the sector that I would definitely look at as one that can give you more gains, because it's fallen so much, and if it does start a retracement rally, you tend to get the percentage gains tend to be much more than just frontline index stocks.
Any thoughts on oil prices themselves? You think that we headed much lower? WTI is already 35.
No, so that takes us to the broader question around commodities. I think the commodities as a whole is in the last leg. So now, if you spoke to me all of last year, I was negative on commodities. Now, at this point, I wouldn't be bearish on commodities anymore. That does not mean oil cannot fall another $1. But I think you're too late into this trade. If you didn't sell oil at $100, you didn't sell it at 60, 50, 40. Now you want to sell it at $38. I wouldn't be doing that. And if you look at sentiment readings, I read about the daily sentiment index. It's a survey done by Trade Futures about futures traders around the world. And in all of the commodities, crude, 94% of the people are surveyed are bearish. Copper, also it's around 95%. Gold was at around 95% around 2 weeks back. All of the commodities are reaching an extreme in sentiment where, up to 95-96% of the people are just bearish. And that typically leads to a bottom. And now it's happening across commodities, not just in one or two. So if people are bearish across the board on all commodities, most likely you're making a medium-term bottom. As and when it turns, it will be a multi-month rally in the commodity space.
But it's also possible that when we say bearish, they're not expecting prices to gain, right? They're not expecting it to fall more, but they don't expect any returns from there. So it's not exactly positioning in that way. That they're short or something, right?
Positioning.
It is 80-90% that you said.
These are futures traders. Yeah, these are futures traders, so it is positioning. You can also measure it with the CBOT data. So you actually look at what commercials and traders are positioned. Say, for example, you just take gold. You have the maximum net short position in, say, 6 years in gold just a week back when it bottomed at $1050. And the commercials actually went long, which rarely happens. So, and this kind of thing is now slowly showing up in crude as well. You have extreme positions as well. So it's not just just a survey. It's a survey of actually traders, futures traders. So it reflects in the positions as well, which you can check up on, CBOT. So you have an extreme situation in terms of both positions and sentiment. You saw that in euro. Say, for example, when the ECB meet happened, why did you get that big jump in the euro? Essentially, at that point, everybody was short. It was a concentrated trade. So it was more to do with that than any expectations with the rate itself. And if you saw the sentiment, similar sentiment on the euro was at around, only 4% people being bullish. So 96% of the people were bearish on the euro. And that led to a big move. So these data points do play an important role, and they have a medium-term implication. So they don't have an implication for a day or two, but we are looking at, significant extremes right now.
Is it possible that after the Fed hike, so the counter consensus view is almost kind of the consensus, right? Many are saying that after the hike, you expect a meaningful rally because of the oversold conditions primarily. Could it be the opposite, that the market just sells off and we see a meaningful cut actually after the hike?
So, so the extremes that I'm talking about, of course, in commodity space, in equities itself, the very short term can be a little volatile, but if you consider just that, it's going to be a small 25 basis points hike, the way it has been dealt with is that they've used, we discussed this last time, forward guidance. Now, what that has done is if rising interest rates meant a higher dollar, the dollar is already higher. If it meant falling currencies, most currencies that were weak during this period have already fallen. You had currency crisis, you had country level crisis like Russia and Brazil. So we've already seen all of that, so you're at the fag end of this thought process. So you get that rate hike, it will be more like, like you say, buy on expectation, sell on news. This is going to be sell on expectation and buy on news, So when the news comes out, the worst is already done. It's already been priced in so many of these markets that it might, if at all there's a reaction, like you're saying, it might be just a short-term 1-2 day blip that will soon be gone.
Rohit, thanks very much. Useful discussion as always. Appreciate you joining us this Friday morning. Have a good weekend. See you back soon next week. Thanks.